There are over 25 S&P 500 stocks reporting earnings on Wednesday, January 28th. We're going to look at 8 of them. We're going to look at Tesla, Meta, Microsoft, and a bunch others, dialing into price action, market timing, and momentum because I'm HEMA ready and that's what I do. So here we have Tesla. It's been in a nice uptrend since April of 2025. And the recent price action is setting the stage potentially for shares to return higher, but they need to do a couple things in order for that to happen. So to start with, I want to see them get above this high from January 12th, okay? That would reverse the short-term correction that's in place. If they do that without breaking below the January 20th low, then you could actually use price action and momentum, my RSI Power Zones indicator, to calculate an upside target. But if shares instead actually trade below the recent low from January 20th first, okay, so they don't break above the high, they actually trade lower, then I'd watch out for a move back towards the November lows. Now here's Microsoft. It's been journeying lower since late October, most recently via the January 7th high. It has had a strong pop higher since January 21st, and that was on making a way back towards the upside gap from last May, but not approaching it. This is with the RSI Power Zones still between the bear zones, the upper and lower. So what I'm seeing here is that there's room for Microsoft to keep going, but it really does have to clear the January 7th high. If not, I expect a return to the January 21st range. Now, Meta has also been making a strong recovery the past few days, but still, it's been dominated by the bear resistance power zones since back in September of last year. Now, it did move above a recent high that I thought would be one of the earlier signs of strength. I would like to see it post a daily closing break above the December 22nd high to really give confidence that we're in a new renewed upside move. We may see that sort of acceleration with earnings coming out. And if we don't see that, if we don't see a closing break above this recently violated resistance, then I'd watch out for a pullback towards the $618 area. Okay, now we're going to look at 2 chip stocks. So we're going to start with LRCX. Now, this guy has been up and to the right, looking pretty strong, lifting beautifully out of bull support power zone last November, and really not looking back except for one more dip there in December. So if you happen to be long this stock, you're in a good position. I would place your trailing stop if you want to maximize profits below the most recent low from January 23rd. If you don't have a position here, you got to wait and see if it has a pause or a pullback after earnings. That might be an opportunity for a new long position. Next, we look at NOW ServiceNow, and it has like the opposite story. So this is a stock that's been tanking, falling down to the right, most recently into the depths of the RSI power zones, going below the bear support. A little bit of a recovery, but this is not looking very healthy. The downtrend is still very much in place. So while beneath the January 7th high, I would watch out for further weakness. Okay, let's wrap up with some macro industrial consumer stocks, a mix of cyclical clues and consumer behavior coming from these charts. So this is DHR, Danaher Corp, and this is a stock that's been up and to the right. Now for some perspective, I'm going to go to a higher time frame, and you can see it's recovering off of its October 2024 high. Most recently, it has sort of been coiling near the neutral levels on the RSI power zones, but still remaining higher. So sometimes momentum won't give you an actionable signal, but it will let you know that the price action is kind of taking a pause and a break. And while above this most recent platform from December 17th, I think there's room for these shares to trade higher. ADP, it looks like the chart flipped upside down, right? Tanking down to the right. Most recently, doing all this business, which looks to me like redistribution. So there's basing, which is where you would think, oh, shares are being bought up by institutions getting ready for a pop higher. And then there's this redistribution. Classic sign is when you see it happening with the bear resistance power zones capping along with recent price highs. So if we see continued weakness below the January 2nd low, with earnings possibly fueling the fire, then I would watch out for significant pullback. Since this is a stock in a downtrend, let's look at the higher time frame to see what is ahead as support. That's this July 2024 range in the $240 area to begin with. And last but not least, we've got Starbucks, if you want to be all formal. So we've been returning back towards the July 30th high, hanging out in that range. RSI power zones still up and to the right, though they haven't reached higher into the overbought territory for a bull market. So I think that as long as we stay above the January 20th low, this still has room to go higher to revisit the June or the July 30th range there, okay? So these are sort of the two guardrails to watch. Now, let's go back to a higher time frame. You can see that this is what has been kind of capping the action on the stock for more than a year. So probably expect that to stay the same unless the earnings give some really big driver and we get a gap one way or the other. All right, that's a look at tech core stocks as well as some chip stocks and consumers reporting on January 28th. If you found value in this video, helpful stock picks that you can monitor, or insights on momentum, which I dove deep into, go ahead and punch that like button and I'll catch you in the next video.